everyone, and welcome back to the Business Mindset. In today's video, we'll be talking about recession-proof investments. Make sure to watch till the end. Some sectors that tend to perform during the recession are healthcare, utilities, rental properties, high-dividend and low-volatility stocks, etc. We have discussed some of these in the video for your better understanding. 1. Healthcare stocks and funds. Regardless of whether the economy shrinks or grows, people still get sick and injured. The medical industry continues chugging along in good, bad, or indifferent economies. Under the umbrella of the healthcare industry fall hospitals, day surgery centers, pharmaceutical companies, medical device companies, and companies that produce healthcare products such as bandages. You can pick individual stocks, or you can diversify by investing in an index fund through a broker. Example fund: FHLC Fidelity MSCI Healthcare Index ETF. Expense ratio 0.084%. 2. Utility stocks and funds. The same logic applies to utilities. People still need electricity, even when the economy shrinks. In fact, there's even less wiggle room with utilities than there is with healthcare. Sure, when money is tight, you look for ways to lower your heating bill. But while patients have the option not to pay their medical bills, if you don't pay your utility bill, you lose your electricity and gas. That's why utilities are among the last bills people default on when they're low on cash. Another benefit of utility stocks is their high dividends. As one glance at SureDividend's list of high-dividend stocks makes clear, these tend to be steady income-producing stocks rather than erratic, growth-oriented stocks. They're steady to the point of being downright boring. Example fund: VPU, Vanguard Utilities Index Fund, ETF, expense ratio 0.10%. 3. Low-cost retailers and chains. People may stop buying clothes at Armani during recessions, but they don't stop buying clothes at Walmart. In fact, they suddenly start flocking to discount retailers for more of their needs. During the Great Recession, Walmart sales went up, not down. They rose by 11% from late 2007 to late 2010. Investors noticed too, and their stock returned 21%, including dividends. The same goes for restaurants. Middle-class Mike might stop eating at steakhouses when the economy tightens, but he won't shun McDonald's. Think about it from a habit perspective. It's easier to change where you shop or eat than it is to stop shopping or eating out entirely. To go from eating half your dinners out to cooking every single night takes an enormous shift in behavior. But eating at Red Lobster instead of an upscale seafood restaurant, that's an easy shift. Look low end for recessionary winners. Example funds: why complicated? Just buy Walmart stocks, WMT. Side effects may include feelings of guilt for supporting the world's largest retail conglomerate, in which case you may want to consider Costco, COST, or Kroger, KR, instead. 4. Tobacco and low-cost alcohol stocks. You have to consider it in the context of what people are actually buying with these goods. Comfort. During times of stress, people tend to smoke and drink more, not less. Consider the tobacco company Altria. From late 2007 to late 2010, their stock returned a monstrous 28%, even as most stocks tumbled in free fall. But be careful not to generalize this effect to all sin stocks. Casinos and other gambling-related stocks perform terribly during recessions. And like retailers and restaurants, people flee from high-end alcohol to the lower end of the spectrum. It wasn't a coincidence that Pabst Blue Ribbon suddenly became cool again among hipsters during the Great Recession. Example funds. Rather than broad exposure through a fund, consider picking individual tobacco or low-end alcohol stocks, such as Altria, MO, Philip Morris, PM, or Molson Coors Brewing Company, TAP. If you want to save even more money, quit smoking and give up drinking to live 14 years longer. 5. Low-volatility funds. At the risk of stating the obvious, volatility is a measure of risk, and low-volatility funds are specifically designed to fluctuate less with the mood of the market. They also tend to have lower returns, but hey, that's what you get when you aim for low risk. Often these funds operate by screening for the least volatile funds in a specific index or market. In many cases, that means they include lots of stock types already outlined above, such as utility and healthcare stocks. Some low-volatility funds take it a step further, and also identify stocks with minimum correlation with one another. That leads to a more diverse fund with greater exposure to different sectors. Example funds: USMV, iShares Edge, MSCI Minimum Volatility USA ETF, expense ratio 0.15% for US stocks only. VMV FX, Vanguard Global Minimum Volatility Fund, expense ratio 0.23% for both US and international stocks. 6. High-dividend stocks and funds. For some stocks and funds, the primary returns lie in their yield, not their growth. Utilities and REITs, including mortgage REITs, offer common examples. These stocks and funds tend to be less volatile and suffer minimal losses during recessions as they generate ongoing income. And because they provide an income stream alternative to bonds, they tend to do well when bond yields dip, like, for example, when central banks lower interest rates, lowering new bond yields. But be careful about choosing companies solely based on dividend yield. Sometimes companies try to lure investors with high dividends to distract from their poor fundamental health. Before investing for dividends, learn how to analyze stocks with high dividends based on their dividend payout ratio. Example fund: VHDYX, Vanguard High Dividend Yield Index Fund Investors Shares, expense ratio 0.14%. 7. High-quality companies with strong balance sheets. Fundamentally strong companies aren't going anywhere, even during a recession. But how do you identify a strong company versus a vulnerable company? Learn how to use fundamental analysis to evaluate companies. It forces you to run numbers such as revenue, earnings per share, and price-to-earnings ratio to better understand how the company compares with others in its industry. As you review a company's balance sheet, get a sense of their assets. A company with hefty current and long-term assets and relatively few liabilities can typically withstand a recession. Their over-leveraged competitors cannot, which means that if a recession hits, strong companies tend to emerge even stronger, with a greater market share. Example fund: SPHQ, PowerShares, S&P 500 Quality Portfolio, expense ratio 0.15% per net. 8. Treasury Bonds. No list of recession-proof investments would be complete without US Treasury Bonds. Uncle Sam always pays up. Keep in mind that in a recession, the Federal Reserve tends to lower interest rates. As interest rates drop, so do a bond yield, which means that bond prices go up. That serves you just fine as a holder of high-yield bonds bought pre-recession. If none of that makes any sense to you, read this overview of bond investing for a quick introduction. Finally, remember that you have several options for investing in Treasury bonds. One option is Treasury Inflation Protected Services, TIPS, and another is Bond Mutual Funds. Example funds: FNBGX, Fidelity Long-Term Treasury Bond Index Fund, expense ratio 0.03%. Or go straight to the source and buy bonds from the US Treasury Department. 9. Commodities. When the economy is in recession, everyone drives for the cover of precious metals such as gold and silver. They're the ultimate defensive investment, as the most literal definition of the expression, the gold standard. Granted, no one thinks about them much when the economy hums along healthily. Do your homework before investing in gold or any other precious metal. And precious metals aren't the only commodities available to buy. You can also invest in food, oil, and countless other commodities, many of which are staples of modern life. Do people eat less corn during a recession? Of course not. Investing in commodities such as corn may not be sexy, but no defensive investment is particularly sexy or exciting. Pundits may gush over high-growth tech startups when the economy is strong, but those shooting star investments are often the first to fall during a recession. Just remember that not all commodities inherently do well during recessions, unlike precious metals. Here's what you need to know before investing in commodities if you're new to it, and as always, remember to diversify. Example fund: DBC Invesco DB Commodity Index Tracking Fund, expense ratio 0.85%. 10. Rental properties. Rental properties offer ongoing passive income, predictable returns, tax benefits, protection against inflation, and long-term appreciation potential. They also offer protection against recessions. People still need a place to live, even during downturns. While home values can drop, sometimes spectacularly, rents rarely drop by more than a few percentage points. Consider the housing crisis during the Great Recession. Nationwide, the Case-Shiller Home Price Index dropped by 27.42%, according to the Federal Reserve. Yet Meridian rents did not drop, according to the U.S. Census Bureau. Instead, they simply rose slower than inflation for several years. This happened because during recessions and housing contractions, homeowners often become renters. Even as incomes stagnate, demand rises for rental housing. You can forecast rental cash flow and returns because you know the market rent and your expenses. You also know that, unlike home values or stock prices, the market rent won't fall by 27%. Even in the worst recession and housing downturn in living memories, rents didn't fall. Still, being a landlord isn't for everyone. Be sure to understand these considerations before renting out your first property. And beware of increasing regulation against landlords as exemplified by the eviction moratoriums seen in 2020. Example: to explore rental property returns nationwide, check out Roofstock. They include a wealth of market and return data for each property and offer 2 outstanding guarantees. 11. High-yield savings account. A high-yield savings account might not be the best long-term investment for your money, but it can be a great place to ride out uncertain economic times. Even in an era of near zero interest rates, many high-yield accounts still offer more than you'd get in a normal checking or savings account. And this way your money will be safe during a recession when you might need emergency funds to get you through tough times. 12. Technology stocks. Technology stocks are not always considered a classic defensive play during a recession. However, the COVID-19 recession might be different. With so many people around the world staying at home more than before, technology has proven to be a vital and thriving link thus far. Between binge-watching Netflix, ordering items from Amazon, or connecting with friends, relatives, and workers via Zoom, many tech stocks are holding up quite well during this recession. The trend may continue for as long as social distancing is required. We hope you liked this video. See you in the next one.